First of all, I'll just quickly introduce myself. This is Ron William, technical strategist from MIG Bank based in Switzerland. And this is one of many webinars that we've been doing every month for almost 1 year now. And the current webinar is basically focusing on the US dollar, asking the question, what are the reasons for the US dollar potentially gaining up to 30% in the next 6 to 12 months? So why is it likely that US dollar, based on the dollar index, will gain up to 30% in price value over the next 6 to 12 months? Now, before I actually go into the actual details of the presentation, I just want to quickly kind of let you know a few important contact details for myself, but also for MIG Bank, should you wish to ask questions after the webinar or maybe follow up with us for various other questions. My email address is r.william@migbank.com, r.william@migbank.com. We're connected with various social media websites such as Facebook, Twitter, and also I run an active blog on FX Street called forexstreet.net. And on a kind of ad hoc basis, I update with various ideas on that FX Street blog. I will be trying to keep that more active going forward. Now, what I want to do is I'll probably kind of ask, first of all, each of you that are in the chat now, if I could just get a quick survey, how many, if you can tell me whether you have or not attended previous webinars that I've given. There's been quite a few focusing on the market themes, but also on educational trading techniques. If you could just tell me if you've attended before. And also, just one extra thing that I want to start asking now, if you could let me know which country you're actually logging in from. So which country you're actually based in at the moment. So have you attended previous webinars or not? And which country are you based in? Okay, great. We've got a nice variety here I'm looking at the screen here. So the majority of you have actually attended previous webinars. Thank you very much for continuing to follow our webinars here at MIG Bank. I really try and keep them topical, engaging, but also actionable for you in terms of kind of trading strategies and understanding how to navigate these volatile markets. And for the new people here, big welcome. It's not always easy to kind of work out which is a good webinar to attend and whether there's going to be useful information or not. So I hope you find this webinar of interest, and please feel free to ask any questions throughout. Last point I want to kind of observe on the screen is that there's quite a few countries, people from different countries that are attending: Switzerland, Germany, US, India, London. I can tell you that I sometimes look at the demographics of the different people from different countries, and it's literally the world contribution from all different countries around the world. So the more the better. Okay, let's start. So I usually, for those of you that have attended previous webinars, I always start by just giving you a quick overview of what different trading techniques I actually specialize in. I've been in the market for well over 10 years, and the 3 techniques that I've used throughout that time are on the screen at the moment. First one is market cycles, and this is probably the most important thing to me. Every single day, every single week, every single year, I will look at the economic and time cycles on any given market. And this, to me, provides a roadmap, if you will, to what might happen in the future. Similarly to if you're maybe navigating around a country in a car or on foot, and you need to know how to go from A to B. The best way to do that is to have a map in your hand. And probably the first thing I learned early on in my career was that the most important thing to do is to have a general map, a general picture of the path of the market or various economic cycles. Now, when I say economic cycles, I also mean how different asset classes correlate to each other. So how does the FX market impact commodities? How does commodities impact fixed income? How does fixed income impact equity? All of these markets are always moving in this kind of dynamic system every day that we look and analyze. So market cycles, time cycles, looking at historical patterns, but also economic cycles, looking at correlations between different asset classes. Second is just general chart patterns. This is a great way of understanding the psychology of the market. So understanding if there are any kind of bulls or bears, or whether there's a transition period between uptrends or downtrends. And there are many chart patterns to identify in the market. But even more specific than that, for many years I've specialized in Japanese candlestick patterns. And these are very timely signals that you can look at in the market that literally, at least in my case, give me an edge in trading because the signals can be produced in a very short space of time. The majority of Japanese candlestick signals are reversal signals. So what I tend to say is in volatile markets that can be very useful because the market tends to produce many price swings, and so Japanese candlesticks is quite useful during volatile markets. Last but not least, indicators. Indicators are important to me, but I focus on price structure first. When I do look at indicators, I tend to look at the classic indicators, but also a lot of advanced indicators, one of which is called DeMark indicators, developed by a very well-known investor trader called Tom DeMark. His indicators tend to look for counter trend moves in the market, so they also look for reversal signals, and they're very good for market timing. Tom DeMark is a individual that I had the fortune of working with my previous job for many years, and so I started to adopt his indicators through my experience of working with him. And then, of course, in addition to DeMark indicators, I also use my own proprietary indicators. Just after several years of experience, you tend to kind of customize your own indicators to look at the market. So market cycles, chart patterns, specifically Japanese candlesticks, and then lastly, advanced indicators such as DeMark indicators, but also my own proprietary strategies. Okay, now let's talk about the key points that we're going to cover today. Usually it's quite a short session, and I usually overrun. So I'm going to try and keep this concise. There are 3 parts to this webinar. The first part is starting by looking at the US dollar big picture. Always important to start with the big long-term picture of any market that you look at, just so you get an idea of the history. History teaches us a lot of lessons, and so the question I ask here is, what does history tell us about the US dollar? Within that same part, I kind of make the point, know your cycles. And I'll explain exactly what that means when we reach that side. But just keep in mind cycles, different time frames of cycles, long-term, medium-term, and short-term. Part 2, the probability for a 30% increase on the dollar index. So what is the probability of seeing a 30% increase in price value of the US dollar index, the DXY? How will this influence the euro, which is heavily weighted within the dollar index? Remember, the dollar index is worth about 50 or so %. Over half the weighting of the dollar index is actually toward the euro. So how will this influence the euro and related currencies? I'll focus on a bit of the major currencies, but also say a few points about other related currencies as well. Part 3, the last part, will be focusing on the other side of the equation, commodities, and how potential weakness in gold, silver, and just general commodities may actually add further strength to the US dollar. So a lot of you will be very aware of the big price falls that we've seen in gold and silver recently. Gold is roughly about 20% off its high. So gold has obviously kind of declined by 20% in a short space of time. And silver, as we speak, is has lost 50% of its value from its all-time high, around the $50 mark. So how does this affect the US dollar? And within that last part 3, the big question about safe haven flows, and the question I ask here is, what happens to safe haven flows in a world that is running out of options, running out of places to hide money? So how does this affect the US dollar big picture? So I'm just going to quickly look at the screen as well, just to answer some questions. Someone's asking, what is the effect of the Fed buying long-term bonds and selling short-term bonds to the dollar? I'll hopefully have a moment to say something on that. Another attendee is very kindly saying, good call on gold in your last webinar. Thank you very much. Yeah, another person saying your gold prediction came true. We've received a lot of good congratulations from clients and prospects and obviously attendees at our webinar following the webinar on gold, where we predicted, and it was recorded on the webinar, but also recorded on CNBC, Bloomberg television media station, and our own kind of special reports here at MIG Bank, calling for a sharp price fall on gold. We have seen the first part of that price fall down 20%. I'll say a little word or two on gold in the last part of this webinar, talking about why it's really important if gold closes on a sustainable basis below $1,600, what that would mean, what type of a larger decline would that actually create. So thank you very much for that positive feedback. I'll go into the gold point at the end of this webinar. Okay, so I always like to start my webinars with a question. Anyone that attends these webinars really should feel encouraged to participate. It should be a two-way conversation. I like to teach, but I also like to learn from you. So my first questions are usually a gauge of how everyone in this forum is actually feeling about a market. We're talking about the US dollar, and so my question is, how many of you here are bullish on the US dollar? If you could just quickly say yes. The statute, for those of you who are interested, one guy's asking where the statute from. It's from outside New York Stock Exchange in the United States. Famous symbolic picture of a bull and good things that take place. Okay, so a lot of people are saying yes, yes. One person is saying no. So the question I'm asking here is, are you a dollar bull or a dollar bear? Sorry about the scary photos that I've chosen for this presentation. I try and keep everyone awake. So here's a picture of a bear. So bear being a negative move in the market and bull being a positive move in the market. How many of you are positive on the US dollar? How many of you are negative on the US dollar? Positive. How many of you are US dollar bulls? Negative. How many of you are US dollar bears? Okay, so we have a kind of a mix here. It'd be great if FX Street could actually just do a quick screenshot of the chat forum, of the FX Street chat forum, just so we can see the survey, the sentiment survey. And interestingly, we have a few people saying yes. Actually, maybe 70 to 80% of the participants in the FX Street webinar that we're holding today are saying that they are dollar bulls. They are positive on the US dollar index. Now that's interesting because several months ago I asked this same question, and if I remember correctly, at least 90% of the people in the webinar forum were dollar bears. So all of a sudden everyone's become very positive on the US dollar, despite the kind of very obvious economic and also technical reasons, at least in the long term, as to why the US dollar was a negative or bearish currency of choice. Now my question actually is, what's changed? So each of you who maybe were dollar bears in the past few weeks and months, what has changed your mind? I'm asking you this question honestly as well, A, because it's interesting, but B, because it really offers me a good insight in terms of how the market is actually evolving its thinking. Europe crisis, yep. So in a relatively poor beauty contest, Europe is actually looking worse than the US. So it's almost the lesser of two evils, investing in the US dollar versus Europe at this moment in time, with the European crisis increasing. Some people are saying safe havens are running out. Very good point. Speculators have run away from the Swiss franc as well as safe havens and so into the US dollar. Very true. The Swiss National Bank intervened not so long ago and basically told the market, stay away from the Swiss franc and please do not push our currency to record highs anymore because it's hurting our economy. So where else do investors and traders put their money if they want to look for safety? And one person is saying he's bearish on the USA because the USA is bankrupt. So all very kind of interesting views there. One person saying commodities are falling. Another person saying the US dollar is the least bad of all alternatives. So yeah, it's the lesser of two evils. In a poor or weak beauty contest, the US dollar trumps at the top. Money is pouring to US treasuries, which is long US dollar, besides driving yields down. So it's quite a good kind of active conversation going here. Last point I'll read is dollar is only strong because of euro. So one person is actually focusing more on the euro now as opposed to dollar. The fact that euro dollar is now broken down lower and targeting that 130 level. Okay, so hopefully I've read out most of the points. One point I just missed out, negative rating on US may have been bearish. Every country is in debt and most likely will never pay their debt. So that's a good kind of focus on what each of you are thinking individually, and I hope it helps for kind of some kind of cross insight as to what maybe the market might be thinking at this moment in time, because I mean each of you in this forum do represent ideas and thoughts in the market. So very interesting thoughts there. Okay, so the majority of you are dollar bulls. That has been a view which is only recently formed and turned a lot of people that were very bearish in the market to bulls. And some of you are still dollar bears because of maybe the macroeconomic stories as to why the US is still in a very horrible situation economically. And if we look at the technical long-term picture, it also illustrates the depreciation of US dollar currency. So here's that technical chart I was alluding to. This is a long-term chart of the US dollar index going back to the 1980s. And in very simple terms, the US dollar has lost half its value since 1980. So it's a very good reason to be bearish on the US dollar. And it helps visualize the economic negatives in the United States of America at the moment. But then there's a question that I ask, and I always ask this in any forum that I present at or teach, any workshop that I teach at, and that is cycles. Remember the first point I said that is so important in any decision that you make when you look to invest or trade in a market is what is the cycle of that market? What is the long-term cycle, more specifically, of that market? And it's very much like this tidal wave that you can see on the screen. Imagine yourself, if I can just show you here with the cursor, in the early stage of this tidal wave, maybe sailing a boat or swimming, and you have this huge tidal wave coming against you. It's a pretty scary experience. One person is saying, is that a photo of Lake Geneva? No, fortunately the lakes are quite calm in Switzerland. It's not that aggressive. This is definitely an oceanic tidal wave that maybe some die-hard surfers like to take the challenge. No, this is an oceanic tidal wave, a very scary tidal wave. Think of like the big tidal waves that we've seen not so long ago. And if you're swimming or sailing into this tidal wave, it's a pretty scary experience. And this is the kind of illustration that I tend to kind of explain to people when they say, why should we look at long-term charts? The reason why it's important to look at long-term charts or long-term history, to be aware of long-term history, is because sooner or later it catches up with us. Sooner or later there's a lesson in that historical timeline or in that historical chart pattern that catches up with us and affects other cycles within the market specifically. So long-term cycles affect medium-term cycles. Medium-term cycles affect short-term cycles. It's all very much an intrinsic kind of connection between these key cycles in the market. Much like the ocean's tidal wave will impact waves, and waves will impact ripples, and so you have the kind of tide, wave, ripple connection. And so this is what I'm showing you here on the screen, the theoretical diagram of what I just said. The fat blue line is showing you the tidal wave in the sea, or the long-term trend in the market, and that tends to be 1 to several years. The turquoise zigzag line is showing you the waves in the sea, and this is anything from several weeks to a few months in the market. And the dotted red line, which is even more volatile and even more squiggly on the screen, is showing you the ripples in the sea, the very kind of small, subtle movement in the sea, which in market terminology tends to be multi-day to several weeks. So the long-term tide or the long-term cycle is very much kind of maybe where investors focus most of their time, or just people like me maybe look at on a regular basis just to understand the big picture cycle, the macro picture. The medium-term or cycle or the waves in the sea is what probably everyone looks at because it impacts each cycle, long-term and short-term. And this is actually good for understanding potential rises and falls in the market because it'll give a kind of overlay in terms of how high that market will move into the long-term cycle or how far will that price fall into the short-term cycle. And then finally, short-term, the ripples or the multi-day to 3-week short-term cycle is very good for timing. So a lot of you are probably traders here, and here at MIG Bank we produce a lot of short-term trading strategies in our model portfolio. And so the short-term time frame is quite critical for actually choosing entry and exit positions in the market. So some of the questions being asked here is, what is the best method for simple retail traders to access and track cycles? I mean, the very short and sweet answer I'll give you is moving averages is a great way to actually isolate the different cycles. Of course, you want to look at intraday charts, daily charts, weekly charts, maybe monthly charts. That's an easy way for the average day investor and trader to look at cycles. But on the daily, weekly, and monthly charts, overlay moving averages. So simple moving averages or any other average that you might find suitable. The moving averages, which I tend to recommend, 20-day moving average for a short-term cycle, 50-day moving average for the medium-term cycle, and 200-day moving average for the long-term cycle. Remember that a lot of people in the market, traders, technical analysts, and investors, and even economists, look at the 200-day moving average on a regular basis because it's just a long-term benchmark. The 20-day moving average is also used quite a bit because 20 days is the average number of days in a trading week, in a trading month, I should say. So 20 days is the average time duration, time cycle within a month. So 20-day moving average, 50-day moving average, and 200-day moving average, these are good moving average overlays to isolate these three cycles. And someone's asking waves correction 1/3. So where I said correction 1/3, the immediate-term cycle, the turquoise line, just shows you that sometimes it shows you that markets tend to fall by 1/3. They tend to lose 1/3 of their value, and it tends to be the medium-term cycle that you can actually identify that retracement, that price fall or rise. Okay, so there's cycles, and we're just basically talking about how cycles start from the big picture. That big tidal wave that is coming at you, history catches up with you eventually, and so it's very important to understand historical events, but also historical time cycles and price patterns. Keep in mind that the tidal wave affects the waves and the ripples in a kind of a fractal way, and the long-term tide or the long-term cycle is 1 to several years. The medium-term wave or the medium-term cycle is several weeks to several months, and markets tend to correct 1/3 of the medium-term cycle. And then finally, ripples, the short-term cycle, which tends to be multi-day to 3 weeks. And this is quite good for timing. Keep in mind that the best way for each of you to analyze cycles, the very simple way, is to use moving averages. Short-term cycle, look at the 20 moving average. Medium-term cycle, look at the 50-day moving average. And long-term cycle, look at the 200-day moving average. Now, what I want to say is that although the US dollar has lost half its value since 1980, which is a big statement, it's quite bearish, keep in mind that, theoretically speaking, this is where I believe the US dollar is at the moment. So we are in this long-term down cycle, this big fat blue line, the tidal wave, or the long-term cycle in US dollar is down, but along that path, along that roadmap, we are currently seeing a US dollar recovery, which is just part of the multi-cycle overlay. So this is the US dollar recovery, which I believe will probably gain up to 30% in the next 6 to 12 months. And this is how it looks. If you look at kind of 2 or 3 cycles overlaid, this is how it would look on the roadmap, on the cycle roadmap, according to my analysis. Is that clear to everyone? I've repeated some of these ideas a few times just to make sure it's very clear to everyone in the chat. I want to make sure that everything that we're talking about is clear and actionable for each of you here in the webinar. Okay, so US dollar recovery, short to medium term cycle within a long-term down cycle. So yes, someone's asking me, then it will tank. Yeah, I mean, basically my long-term view on the US dollar is very much in line with what it's been doing since 1980, the downtrend. The US dollar is very bearish. It has lost half its value, and most markets which lose half its value tend to continue to lose value. And, you know, technical but also economic situation in the US is bad. It's just at the moment there are various reasons why the US dollar is due a recovery in the short to medium term cycle. Technically, the market is unwinding from very oversold momentum and sentiment and liquidity extremes, but also from an economic standpoint, there's a flight to safety. And as everyone said in the chat at the start, because that there's a decreasing amount of safe havens for investors and traders to put their money, to hide their money, the US dollar is actually taking a very positive, a renewed interest because of the fact that Swiss franc has unwound somewhat, and because of various other markets which are traditional safe havens. Okay, someone's asking, someone saying thanks Alan Greenspan, another person saying, or the same person even saying, Paul Volcker drove the US dollar to all-time highs, just for the record. These are all valid points, and obviously the monetary policies which each of these central bankers choose to take over time definitely impact the market. And in terms of the US dollar, the zero interest rate monetary policy that the Fed Reserve in the United States has chosen to take has certainly made the US dollar less attractive historically. Now, this is a very important chart where I'm going to show you these long, medium-term, and short-term cycles, but I'm going to show it to you on the chart of US dollar. So if you could please really focus on this chart, because it's going to start step by step from simple, and then just it'll start to overlay a bit more kind of advanced overlay. So if you can just focus on the different stages that appear on this chart. So this is the US dollar index, showing you the US dollar index going back to the 1980s. So it's a 30-year historical monthly chart of the US dollar index. And so the long-term cycle we can all see right now. The long-term cycle on the dollar index is definitely down. That's what I started this webinar with, by telling you that the US dollar has lost half its value from that 1980 swing high. So that's a long-term cycle, and that's what a lot of investors and traders have kept in their minds. Psychologically, people are bearish because of the fact that the market's been going down for over 20 years. And so for that reason, people just extrapolate what's happened in the past. They just continue to expect in the future what happened yesterday and before. But keep in mind that there are medium-term cycles within long-term cycles. And so this is one example of a medium-term cycle which gained up to 96%, and then obviously we had the capitulation thereafter. Then we had another medium-term cycle which drove the US dollar up 50%. And then last but not least, the one that I'm speculating, a potential 30% medium-term cycle which runs into this long-term trend line. Now, there are various reasons why the US dollar index rose 96%, 50%, and there are probably, you know, renewed or some legacy reasons as to why the US dollar index may gain 30% now and into the next 6 to 12 months. But just keep in mind that this is what happened in history. Although the long-term trend is down and the market did lose half its value, during that time there are medium-term cycles which rise and fall. Just like the sea, there are waves that rise and fall. And what's key to keep in mind is whenever we get these strong movements in the market, these strong upswings, it's usually followed by a strong downswing. And then we usually have a kind of a recovery stage where the market tends to be quite volatile. And this is the short-term cycle I'm showing you here, which shows a volatile price range, which is basically how the market tends to react after a sharp rise and a sharp fall. The market tends to lock into a slow, volatile accumulation stage following such moves. Now, we've seen a similar volatile range, and that is exactly now since 2004, which is quite similar to the one I'm showing you between 87 and 94. And these are short-term cycles within the US dollar. So I'm just showing you three cycles here. Long-term cycle, the red downtrend line from the 1980s. Medium-term cycle showing you 96% appreciation in value, 50% appreciation in value, and then a potential 30% appreciation in value in the next 6 to 12 months. And that's basically the percentage change from the dollar index low, most recent low, into the trend line. So it's quite a conservative projection in that regard. And then within the short-term cycles, there are obviously kind of various ripple effects or various swings that we have during that recovery stage. And just for the record, these price swings tend to average around 25%. So each of these price swings, I've measured them individually. I didn't stick the number on there because I didn't want to make the chart too noisy. But the average price swing up is approximately 25%. Yes, and medium-term upswings are 5 to 6 years in duration. It's very important. I'm just showing you price values here, but it's very important to actually look at the time axes when you're looking at cycles. Timing is everything in life and in the market. And with cycles, it's very important to actually look at the cycle. So someone's asking right now, medium-term upswings are 5 to 6 years in duration. Do you see similar now? No, I don't. Time is not always symmetrical. In all the cycle analysis I've done, I've realized that over the years. Time cycles are not symmetrical. The duration of a cycle tends to be skewed by the actual price activity, whether it's a bullish market or a bearish market. In a bearish market, time cycles tend to contract. So any upswing in a bear market tends to decrease its time duration. I hope that's clear to everyone. So during a down phase, during a bear market, the bullish swings, the bullish cycles within a long-term bearish cycle tends to be quite short, tends to be a decreased amount of time. And you can see that here visually, where you have this kind of very big upswing, 96%, and so it takes quite some time for that to recover. But then when you have a 50% upswing, that has less time because it's a rise which was much less than 96%. If we have a 30% upswing, again, that then decreases the time duration of that cycle, of that short or medium-term cycle. So in answer to your question, I do not see a similar time duration as this big upswing here, 5 to 6 years. I think it will, in a long-term bear market, the bullish short-term, medium-term cycles tend to be less in time value because the market tends to contract. And so one last person is saying, I think the Fed's monetary policy coupled with inflation usually causes the rise and fall of the dollar index. Absolutely. I mean, monetary, fiscal policy, economic drivers basically are critical to the markets, but specifically FX, for reasons that everyone in this chat is aware of. Now, I hope this chart is clear so far. Can I just get a few yeses from some of you? Is everything so far clear? I've just basically covered 3 cycles on the dollar index, a 30-year chart, the dollar index, long-term, medium-term, short-term, and I'm just showing you how there's a bit of similarity as to what we're seeing at the moment, and how historical patterns can be used to maybe forecast what will happen in the future. Keep in mind that the time pattern is not symmetrical. Time cycles tend to deviate according to whether the market is in an expanding cycle or in a contraction cycle, i.e. bullish or bearish. How can we profit from these cycles? I'll say a few points about that. I mean, basically, once you understand which cycle you're in, then you can understand which type of strategies to use. In bearish cycles, the market tends to be quite volatile, so any kind of adaptive market timing strategy tends to be more useful, and risk management tends to be critical during volatile markets. And when it's a bullish cycle, buy and hold strategies tend to be the norm, and it tends to be easier to use trend following techniques such as moving averages and various other popular trend following techniques. So at the moment, we're in a very volatile period, which may turn into kind of a short to medium term bull trend on the US dollar index. So you'll be using some moving averages during this time. And if you look at the US dollar index, it has risen above its 200-day moving average. But also you'll be looking at some of your volatility-based techniques because the market is still within that transition stage at the moment. Okay, now last thing I want to show you on this chart is the momentum indicator. I do like to use classic indicators, and this is the RSI indicator. One quick trading tip I'll give you is that most people look at the RSI momentum indicator for identifying extremes in the market, so overbought or oversold levels in the market. Has the market risen above 70% or has the market fallen below 30%? These are just general thresholds on the RSI momentum indicator to let you know when the market has moved too fast, too soon, up or down. Now, the other way I look at the RSI momentum indicator and other momentum oscillators is by looking for ranges. During bull markets and bear markets, these oscillators tend to produce ranges. So it's just similar to looking for kind of chart patterns on a price chart, but you would look for this chart pattern or this chart range on the actual indicator. And so I will just show you this just to show how the RSI indicator, if you spot these ranges, how you can identify whether you're in a bullish or a bearish cycle on a market. The RSI setting, by the way, is 9-day, 9 or 14 RSI indicator. There are various reasons why I use that, but they're the traditional default settings for RSI, 9 or 14. Now, what I'm showing you here is one bullish range which existed during the medium-term upcycle where the market moved 96%. Second bullish range, range B, where the market was ranging sideways in the bullish part of the RSI band, and that was when the market rose 50%. And currently, range C, where definitely the market is holding its ground above the 40% level, potentially helping this big recovery from historic oversold momentum levels on the US dollar index. So that's just a quick tip from me in terms of another way to use momentum oscillators. And here I'm showing you the RSI indicator, looking for bullish and bearish ranges just to support the cycle that you're looking at on the market. And so this is just clearly showing you a bullish range A, B, and C, where the US dollar index has clearly been in a positive uptrend and potentially is at the moment, and may continue to do so in the next 6 to 12 months. Now I just have another question here is, unwinding of leverage in the market and rebalancing economics across West and East could take several years, 5 years or so. Do you agree? Possibly, but that's a question that's probably best that I answer maybe privately. If you shoot me an email at the end, I can come back to you on that because there's a few points I would include in that. But is this slide clear to everyone? I just want to make sure this is my roadmap basically for the dollar index going back to over the last 30 years. So someone's saying, is the 40 limit for the RSI in bullish ranges and bearish below? Yeah, I mean, I don't like to give hard and fast numbers, but generally speaking, when the RSI holds above 40 and then pushes up into the 80 to 90% region, that is a confirmed bullish cycle. And if the RSI holds at the 60% level and pushes into the 20% or even lower level, then that would be a bearish cycle. Okay? I hope that helps ask your questions. And yes, I also look at divergences. But when you're looking at long-term history such as this, ranges can also be equally useful as divergences. The one point I'll say about divergences, it's very important to actually look at how long that divergence in the market between price and the indicator has held for. I might include that in various trading webinars in the future in terms of how to properly trade indicator divergences. Okay, so I'm going to move on now because we're running out of time. So this is the US dollar index, 30-year chart, just basically showing you the long-term cycle, the medium-term cycle, and the short-term cycle, and just showing you, most of you would have just been focusing on this because psychologically it's quite a really kind of hard and fast memory to keep in your mind for over 20 years, for 2 generations in your career, or even people that you've worked with. People have investors and traders have known the US dollar to depreciate in value. It's lost half its value, and so everyone just kept that in mind. And the news has been quite bearish, so a lot of people have been kind of perma bears with regards to the US dollar index. But keep in mind that during that time we have medium-term cycles or upswings, 96%, 50%, potentially 30%, and then once we've had these kind of big upswings followed by downswings, we tend to have recovery stages, short-term recovery cycles, which tend to be volatile, and we're currently seeing something very similar to one we've seen before. Once we break out of that volatile range, that obviously offers the bulls even more vantage point on the upside for a test of this trend line. And then I just showed you the RSI momentum indicator just to kind of give you that trading tip for looking for ranges, bullish and bearish ranges on the RSI indicator to confirm these cycles, these medium-term cycles. Okay, next chart is just a short-term chart of the US dollar index, and I'm just showing you what you probably all know. The US dollar index is at a 9-month high as we speak, and it's almost 10% up from its April lows, from its major lows. The major lows or the actual turning point was actually signaled by many indicators, but the one indicator that actually gave the most timely signal for the US dollar reversal, bullish reversal, is Tom DeMark's indicators, specifically sequential and combo. Now, for those of you who are not aware of these indicators, if you can just kind of maybe shoot me an email, I can send you some more information. But these are indicators that I include in the MIG Bank research report on a regular basis. These are indicators I look at on a regular basis. So the DeMark exhaustion buy signals 13 and 9 signaled on the actual week and day buy signals on the US dollar index. Now, of course, the US dollar index then kind of continued to move sideways in a volatile price range, which caught the best of us out. And people weren't sure whether the dollar was going to make new lows or whether the dollar was actually going to break to new highs. And so what it's currently done is broken out of this trading range. And as we all know, any trading range that breaks into the market tends to create a whole new momentum stage. And this momentum stage is pointing to the upside and targeting 80 and much higher. We're probably going to hit 80 in the next few days or the next few weeks. So just keep in mind, US dollar index is at a 9-month high and has gained almost 10% from its recent major lows. So anyone who you speak to out on the street or at work who says they're perma bears on the US dollar index, just make the very kind of simple but smart point. US dollar index is at a 9-month high, so that's got to matter. That's got to show that there is buying interest at the moment. And you've got to ask yourself the question: why has the US dollar made 9-month highs, and why has it gained 10% in value? Despite all the economic deterioration and the fact that it's been technically so bearish for so long. So someone's asking, how long will the dollar be the world reserve currency? Very good point. Part of the reason why the US dollar index is actually gaining interest at the moment because of safe haven flow is because it still is the reserve currency. And so despite what we might think, as to what will happen in the future, and there are many things that will happen, like, for example, China may be taking some leadership role, as it already is economically, in terms of legacy reserve currencies, the US dollar still very much takes that champion seat. And so for that reason, if we're thinking that, everyone else in the market is thinking the same thing. And when people are looking for a safe place to hide money, and other places that they've been looking at have been reduced or have been taken away from the table, the US dollar has taken that benefit at this stage. That's my short answer. So US dollar index at 9-month high, almost 10% from its highs. From its low, recovering higher. Ask yourself the question, why has that happened? Now, the point I'll make on that is that a lot of people say, well, why does the market make, why is the US dollar reversing if it's so bearish, technically and economically? And I want to make this point, which I've made in previous webinars. Certainly I made it in the one on gold, as to why markets make tops and why markets make bottoms. And so I'll just read this out to some of you again. Markets top not because of smart sellers, but because the last buyer has bought. So markets top not because some smart hedge fund or even a big central bank offloaded X currency reserves into the market. I mean, obviously that will have an effect on the market, but it will not change a trend. It will not produce a long-term trend. Trends are produced by mass psychology. Short-term, medium-term, and long-term trends, especially long-term trends, are sustained by mass psychology, global psychology. And what actually creates the major reversal in that psychology is because in an uptrend, when an uptrend reaches its end, when that bull phase has ended, it's because the last buyer has bought. The market, by definition, is overbought. And so for that reason, the market creates a vacuum, and then that produces a potential reversal, just sheerly from the weight of gravity pulling that market down. And the opposite is true. A market's bottom not because of smart buyers, but because the last seller has sold. And this is very true to the US dollar at the moment, the dollar index. The US dollar index is reversing primarily because so many people were bearish in the US dollar, so many people were selling the US dollar, and so there were no more sellers in the market. And just by definition, that created a vacuum on the upside for buyers to then change the equation and then create a transition for the short to medium term cycle higher. So keep that in mind. Markets top not because of smart sellers, but because of the last buyer has bought. And a great example for that is gold. Gold, everyone thought it was just a one-way trade, just buy and hold, and gold will continue to go up because of safe haven flows and because it's a great hedge against fiat currencies. But everyone, or majority of people in the market, forgot that gold, like every other market, is driven by market psychology. And market psychology and market trades had become overcrowded. Gold had become overbought, and so that's why it corrected 20% in a very short space of time. And here in this example, the US dollar had become oversold, and that's why we're seeing a recovery to 9-month highs, 10% from recent lows. Okay, now a way that you can actually measure the liquidity in the market, or actually see the positions in the market, is just by looking at speculative positions in the market. Now you can look at this from the CFTC exchange in the United States. I'm calling this COT liquidity. It's just showing you the net long speculator positions in the market. How many people are buying the US dollar index? And these are trades which are large trades which are reported to the US exchanges. They tend to be kind of driven by hedge funds and various large speculators in the market. And what this shows is that historically the US dollar index has obviously been driven by positive speculative flows in the market. And we see here plus positive move here where I've shown the golden arrow. The market rose 27% in the most recent cycle. And then again, when we had a big push in speculative flows, we had a push of 19%, and the US dollar pushed higher, less than the previous cycle, but it still pushed higher. Now currently, this is the situation that we're in, and liquidity readings, according to the ones that I look at, were unwinding from record lows. So the people in the buyers and sellers, or should I say traders and investors in the market, were basically selling the market at extreme levels. We have never seen such historic selling pressure in the US dollar index as we saw in March of this year. And so just generally, I and a few people that I know in the industry were looking for potential mean reversion, potential unwinding of this historic selling pressure in the US dollar index to unwind and then push back higher. We pushed higher, then we pushed down. It was a little volatile, wasn't too clear. The market was obviously within a trading range, and so the liquidity readings weren't so clear either. But what we did see just very recently, last week and this week, is that liquidity readings punched above our key trigger level. I haven't highlighted it here, but it moved above 15,000 contracts, which is an important trigger level for me, and actually pushed to the major highs here. Now, for those of you who maybe look at statistics, this move here in speculative flows is just about 3 standard deviations above the yearly average of speculative readings on the US dollar index. So the 1-year average reading of speculative flows on the US dollar index, the market has just surpassed it by 3 standard deviations. That's what these two up bars illustrate. And so this is very positive, because any market that is actually backed up by positive liquidity readings, especially by this amount, basically means that the market move will be more sustainable because liquidity is actually backing the market. People are putting their money where their mouth is, basically. They're actually actioning strategies and they're putting money into that. And that's a great indication. So most of you who maybe look at the equity market, any rising stock in the market, you would look for rising volume as well to confirm the sustainability of that market move. It's the same thing in FX, but what you would look for in FX is a CFTC liquidity reading. Okay. Sorry if I'm speeding up a little bit. I'm just I'm very conscious of time, and I just want to kind of get each of these points mentioned. Someone saying, is carry trade with the US dollar as a funding currency, which is being unwound, and risk aversion must increase demand for US dollar and more buyers? Absolutely. So I'm kind of showing you different technical, but also sentiment and liquidity, but also I'll end off with economic reasons as to why the US dollar is gaining in value at the moment for the short to medium term cycle. And very much what you're saying now makes sense. One other person saying, tell us about gold and silver and oil. I'll cover those markets right at the end. Okay, so we've covered part one, US dollar big picture. What does history tell us? Know your cycles. Remember the long-term, medium-term, and short-term cycles, which I alluded to, was very similar to the ocean tidal waves. Part two, the probability for seeing a 30% increase in the dollar index. The dollar index is actually made up of a basket of currencies. And so I want to just quickly review the currencies that are weighted within the dollar index, just to see on an isolated basis what those individual markets are telling us. Euro dollar, dollar yen, sterling, and various other currencies. And then finally in part two, how will this influence euro and related currencies? Remember, part three, we will be looking at commodities, and we will talk about safe haven flows. So part two, probability of the 30% increase in the dollar index, and how will this influence the euro and related currencies, which is obviously included in this basket on the dollar index. Okay, so these are the weightings. For some of you who maybe want to note this down, please keep in mind that this webinar is recorded, so if you've missed anything or if you want to go over anything, you can watch it again. It will be available on the FX Street website. US dollar index is weighted as in the following currencies. Over half of the US dollar index is weighted in euros. And that's very important. So a lot of people say that US dollar index movement reflects or mirrors inversely the euro. And that's very true, because more than half of the US dollar index is actually weighted towards the euro. Japanese yen is 13.6% worth of the US dollar. British sterling is worth 11.9%. Canadian dollar is worth 9.1%. Swedish krona is worth 4.2%. And finally, to answer the question that someone just asked, Swiss franc is only worth 3.6%, so it's similar to Swedish krona. But of course, we know recently that Swiss franc has had some massive moves in the market, and that has maybe helped the US dollar index in recent days. So just keep in mind, euro, Japanese yen, sterling are the top ranking currencies in the US dollar index. Over half the weighting of the US dollar index is denominated in euros, and then we have 13 or so % in Japanese yen, 11 or so % in sterling, and then the remaining three, Canada, Sweden, and Swiss franc. Okay, so there's a few questions here. Does purchasing one contract of DXY cause its price to rise? Not necessarily, but I understand what you're asking with that question. Another person's asking, as mostly euro, why call the US dollar index? It's more of a technical question, that one, but I mean, it is, although half of it is skewed towards the euro, there are other contributors, and I'll mention why this is important. And then just finally, someone's asking about dollar yen had a hard time moving up the US dollar index. Yes, absolutely. The Japanese yen has held back the US dollar index. I'm going to quickly move on. FX Street are just kind of giving me a heads up that the webinar needs to end soon. So just going to quickly cover the charts. Euro dollar, with its half weighting, has broken out of this trading range, and now that it's holding below 140, is now targeting 130, and in my opinion, in the weeks and months ahead, may target 120, which is the bottom of this trend line. Remember, it's broken it below its trading range, its 200 moving average, and this 2-year uptrend. So euro dollar likely to push much lower as the situation in Europe gets worse than the situation in the US. Remember, some of you already said that this is the lesser of two evils. It's a weak or poor beauty contest between Europe, UK, and the US, and right now Europe is taking center attention as being the worst of the worst, and so for that reason the euro is actually reflecting that sentiment and the market is pushing down. Keep in mind that despite the bailout fund that was actually approved of last week in Europe, the euro still continued to push lower, and as of today, we've pushed to new lows. So euro dollar more than likely to push to 130 and even further down. Some of you can actually read about this, my views on the euro. I wrote a special report on this, and you'll be able to find it on the MIG Bank website and on the FX Street website. It's called Euro Dollar, a Fall from Grace. I'll be updating that soon, so keep watching. Dollar yen has been the ugly sister of the whole group. It's been holding at these historic post-World War II lows after the crisis, the earthquake which happened in Japan, and we're basing at the moment. My opinion is that the dollar yen is basing, but it's actually undergoing a major cyclical reversal to the upside. And I believe that, once we push above 78 and then 80, we will see big moves into 82 and even 85. So I'm very bullish on dollar yen, but so far I've been wrong on the timing. Each time I've been looking for a bullish reversal, it hasn't happened. And a lot of that is actually down to the Bank of Japan intervention, kind of scaring people away from actually trading this currency at the moment. But keep in mind that dollar yen does hold a 13.6% weighting in the US dollar index. So once the Japanese yen actually starts to depreciate in value significantly, that will really start to impact the dollar index. Cable, I won't say much about. It's bearish at the moment, but my good colleague, BJY Carr, covers sterling dollar here in the MIG Bank research team. So he'll have a lot more to say, so feel free to read his comments on a daily basis to see his views on British pound. But you can see here it's quite bearish, it's below its 200 moving average, and that is worth 11% of the index. And then finally, dollar CAD has been amazing so far. It's really pushed from its summer lows, and now is breaking even higher, targeting 107, 108. Dollar CAD is one of the currencies I cover. And again, we're seeing a big shift from commodity-driven currencies such as Canada, Australia, South Africa. These currencies are really unwinding as commodities unwind, but also as risk appetite starts to decrease. So the big commodity-driven currencies are also unwinding, as well as the emerging market currencies. So dollar Canada is one of those examples with 9% weighting. Sweden at the moment is recovering out of this kind of base pattern, and we've got this very kind of long-term turn in the market, which may push into 7.5 and 8 over the medium-term, long-term. We'll have to watch closely to see that. Someone's asking, how can we get access to regular commentary to follow more closely? I'll say right at the end of this webinar how you can actually receive our reports. I'm just going to quickly just run up. And then dollar Swiss, again, my good colleague BJY Carr covers this, but we can see obviously that dollar Swiss has had a major recovery. So a Swiss franc has unwound over 10% from its record highs. That actually happened before the Swiss National Bank actually intervened. There was already a technical reversal in the Swiss franc, specifically against the dollar. But we can see here how it's risen above its 200 moving average and continues to push higher as safe haven flows start to drive away from one of the most traditional currencies, the Swiss franc. Okay, so I've covered all the currencies in the dollar index. I just want to quickly end off on another currency index. It's not just the dollar index, the DXY, but there's also another US dollar index, and it's the Asian dollar index. And this is actually constructed by JP Morgan. A lot of the big sell-side investment accounts have constructed their own currency indices. And this is a currency index of the US dollar, but the US dollar against the Asian currencies. So countries like China, Singapore, Thailand, and various other countries. This is just showing you a weighting of the US dollar against Asia. And so when this chart goes up, it's showing you that Asian currencies are appreciating against the US dollar. When this chart goes down, Asian currencies are depreciating, but they're losing value against the US dollar. So what you're seeing here is that since March of 2009, it's been a very strong uptrend, and even further back than that, it's been a strong uptrend. But very recently, since August, since summer, late summer of this year, just a month or two ago, we've had a major capitulation in the Asian dollar index. And one of the most topical currencies is the Singapore dollar, which is often seen as a safe haven currency, similar to the Swiss franc, has actually also reversed strongly above its 200-day moving average. So look at the Singapore dollar. But what this is showing you, it's not just the dollar index against the Western currencies, but it's also the dollar index against the Asian currencies, showing you that people are unwinding out of the Asian currencies, the high-risk currencies, and this will obviously have a positive effect on the US dollar. Now, my final part is literally 2 slides, so if you could just bear with me, FX Street, just literally 2 slides. We're going to cover gold, silver, and then safe haven flows. Gold, silver. My big call on gold has been a major price fall of up to 28%, and that's mainly down to this long-term chart showing you gold going back to 99 on a log chart percentage scale. And what this shows is that the average largest price falls on gold has been 28%. And so I was saying that the market was very overextended according to various momentum indicators I was looking at, specifically the market indicators. As we approach $2,000, a big psychological level, and also the fundamental action that took place at the CME exchange where they increased margin requirements by up to 55% very quickly, obviously added a lot of downside pressure on gold bugs and forced people to basically unwind out of their positions. So everyone that was leveraged in gold because they believed it was a one-way trade had to literally just push their trades off the cliff, and that's why we had a very sharp move on gold down, which is already 20% lower, and obviously that's had a very positive tailwind on the US dollar because of the inverse relationship. Remember, commodities are priced in US dollars, so there tends to be an inverse relationship between commodities and the US dollar. If gold goes up, US dollar tends to go down, and vice versa. Here we have gold going down by 20%, and that's having a positive effect on the US dollar index. One point I'll say on gold is if we get a sustained close below $1,600, I am actually forecasting gold to go much lower. In a recent special report, which you can get on FX Street or MIG Bank, a sustained close below $1,600 and actually the 200 moving average around 1530 will, to me, signal a potential extended decline into $1,300 and even $1,000. This, to me, would be a buying opportunity into next year, 2012, but for now, it's a short to medium-term down cycle, which may increase even lower. Silver just very simply has lost 50% of its value and has basically shown investors and traders out there that lightning can strike twice after it capitulated a second time around. The first time around was April this year, which in my opinion was the start of the unwinding of risk appetite, phase 1, when silver capitulated by 30% in a week. And just very recently it continued even lower. I believe that silver may continue even lower into $21 to $20, and again, in the long term, that will create a rare buying opportunity, but for now, that will create a lot of good upside pressure on the US dollar index. My very last slide, FX Street, thank you very much for being patient with me, and it's just this picture of dominoes. I like to be very visual with my analysis, and it just shows the world is running out of safe places to hide money. So because of what's happened, Swiss franc was the first favorite for everyone in the market. The Swiss National Bank intervened and basically asked everyone in the market to stay away from the Swiss franc because it was at record highs and it was affecting exports. So people moved out of Swiss franc. A lot of people expected the market to go into gold, but then gold was an overcrowded trade into $2,000. Gold unwound 20%. So where next? Japanese yen people are avoiding because maybe of the Bank of Japan intervention, and it's already at historic highs. So people are a little wary about that. U.S. treasuries or government treasuries generally are a bit of a gray area. And last but not least, the U.S. dollar index is likely to, again, to repeat the conclusion and the theme of this whole webinar, to gain from all of this. Major gold decline or just general commodity decline, gold, silver, but also oil, copper, a lot of the commodities which are included in the commodity indices, and an unwinding in risk appetite, which we're already seeing in an acceleration fashion at the moment, renews a flight to the US dollar. And remember, this is a lesser of two evils. This is a poor or weak beauty contest between each of these asset classes and even each of these currencies, US dollar, sterling, and the euro. And the US dollar at the moment is gaining most interest. And remember, potential 30% gain in the US dollar index over the next 6 to 12 months. That is my forecast. and that is the theme of this webinar. I'm just going to end off. Any questions that you have, please just email me on r.william@migbank.com. Any of the charts that you found interesting during this webinar, also just ask me. I'm happy to share that with you. And we have a kind of exclusive 1 month free trial offer so that you can receive our research. If you want to receive our daily reports, we have daily technical analysis reports on each of the markets that you look at within FX and also commodities. I'm happy to send that out. So that's it for me. Sorry about speeding along in the last part. Thank you very much, FX Street, for being patient with me in terms of the going over the time. My last thing I want to say is it's always an honor and a pleasure to host these webinars. I really hope that it's been enriching for you as much as it is for me. And thank you very much. Enlightenment to realize knowledge. Thank you very much, everyone. And please feel free to register for our next webinar in November, which has already been featured on this website. Thank you very much, everyone. Thank you, FX Street. Bye-bye.